Okay, good evening, everyone. Thank you for your time to attend tonight's webinar. Okay, my name is Abigail, and I'm a marketing executive and also a dealer of Phillip Futures coaching branch. So, before we start, I would like to do a sound check. Can you hear me? If yes, just type into the box. Okay, I can see that you can hear me. That's great. Okay. Just some disclaimer before we start, okay? Whatever we share tonight is just for general information. It does not constitute any recommendation to buy or sell any investment products. Okay, to introduce about our company, Phillip Futures is a wholly owned subsidiary of Phillip Capital. We are incorporated in the year 1995. So our mother company is Phillip Capital, which is from Singapore, and our headquarters is based in KL. And we have branches in different parts of West Malaysia, as well as in Sabah and Sarawak. Okay, Phillip Futures is a trading and also clearing participant of Bursa Malaysia derivatives. We are also a holder of CMSL, which means that we are a legal and regulated broker house in Malaysia. Okay, I'd like to take this opportunity to thank our clients for their trust and support in us. So in 2020, last year, we have won 3 awards from Bursa Malaysia as the first runner-up for the best overall, best retail, and also best institutional derivatives trading participant. Can you guys hear me? Can, right? Okay. All right, let's continue. Okay, so Phillip Capital, our mother company, has a network around the globe. So we are not only have offices in Malaysia, we also have offices in over 14 different countries. And with that, we provide products not just in Malaysia, but we also offer products listed in other foreign exchanges. For example, in the US, Europe, Japan, Hong Kong, Singapore, and so on. So Phillip Futures, we focus on 2 main products. One is futures and also one is the FDs. So for futures, we allow our clients to trade different category of products such as index futures, metal futures, agricultural futures, energy futures, and also interest rates futures. And for those who trade the stock market, we also offer CFDs or contract for difference in Bursa and also US markets. Okay, so why choose Phillip? So first, we offer 24 hours broking and execution support for our clients, which is especially helpful for those trading the foreign products at night. So you can call in our dealing desk for any help if you need. And then next, we also send out latest market news and commentaries to our clients every day through email. And we also provide advisory service on how you can get started on trading. And lastly, we provide a wide array of products that allow our clients to trade from, be it local or foreign products. Okay, so other than that, we also provide a free one-to-one coaching sessions, free webinars like the one you're attending tonight, and also free account opening. So in our free one-to-one coaching sessions, we cover topics like introduction to futures trading, product knowledge, platform coaching, and charting system. So these are mainly catered for beginners. Okay, this is our upcoming webinar session. It is a Chinese session on the introduction to futures trading. If you're interested to join, you can scan the QR code to register for the session. Okay, so let's dive into our topic tonight. So we'll be touching on the basics about futures trading and how you can get started. So before I start, can I know how many people here have experienced trading in the futures market? Like, can you let me know in the comment box if you have traded futures before? You can type 1. If you've never traded or not sure what is futures, you can type 2. Okay, I see some twos and also some ones, so quite a mixture lah. All right. Thanks for the response. So tonight, for the webinar outline, we will talk about what is futures trading and how it works. Why do you want to trade futures? And we also talked about introduction to KLCI, FM70, and FCPO. And then we'll cover the key fundamentals that drive these markets, and also how to begin trading with Phillip Futures. So what is futures and how it works? The definition for futures contract is basically a legal agreement to buy or sell a commodity asset or financial instrument at a specified date for a stated price in the future. So a holder of the contract can fix the price of the asset today that they want to sell or buy in the future, maybe 1 or 3 months later. So futures contracts are standardized agreements that are traded on the exchange. Okay, here we have 4 main categories of the futures market I have roughly talked about just now, but we'll look into these 4. So agricultural futures, we have examples such as crude palm oil or FCPO, okay, wheat, corn, and coffee. And for metal futures, we have gold, silver, and copper. For index futures, we have the FKLI, Hang Seng Index, Dow Jones, China A50, and also energy futures, we have crude oil, natural gas, and gasoline. These are just some examples lah. And futures contract, they have terms that are standardized, and there are 4 important elements in the futures contract. So the first one is asset class, which is the underlying asset of the contract. So for example, if it is a soybean futures contract, then the underlying asset will be soybean, okay? And the second is quantity, which refers to the size of the contract. Okay, the quantity outlines the exact amount of a commodity or asset that can be bought or sold. For example, 1 contract of crude palm oil, okay, crude palm oil futures gives the holder the right to acquire 25 metric tons of palm oil. And the third one is expiration of a contract. So all futures contracts have an expiration date that is set in the future. So futures have different expiry dates to choose from, which is also why you have different contract months. Okay, and the expiry date is the final day the contract can be traded. So after the expiration, the contract must be settled either by cash or by delivery of the products. And then the last one is the price of a contract. This one will reflect how much value a contract is worth. And the contract will also state what currency it uses, like whether it's in MYR or USD, etc. Okay, as I mentioned earlier, contracts need to be settled at the expiration date, right? So there are 2 types of settlement. One is cash settlement and another one is physical delivery. So for cash settlement, the contract is settled in cash. Okay, the parties either pay cash or receive cash, depending if they are in profit or in losses when the contract expires. And cash settlement are common with index futures, like the KLCI, the Dow Jones futures, etc. It is settled in cash because it is not possible to have a physical delivery of an index. And then for physical delivery, okay, it involves delivering or receiving the actual goods. So the seller of the contract will have to deliver the goods, while the buyer of the contract will have to receive the goods when the contract ends, okay? Physical delivery is common with commodities, like such as CPO, corn, soybean, etc. So how much amount to deliver was already specified in the contract. But usually for retail traders, they don't want to receive or deliver the actual goods. So what they can do is before the contract expires, they will close their positions by doing an opposite trade. All right, for example, a buyer of a contract will close his position by selling the contract before the expiration, and he can profit the difference between the buying and selling price. Okay, this is the example of a contract specification for FCPO. okay, which stands for the crude palm oil futures contract. So a contract specification will outline all the details of the contract. So you can see the underlying instrument here is crude palm oil, and the contract size of one FCPO contract is equivalent to 25 metric tons of CPO. Okay, so you can calculate the contract value for FCPO. Okay, for example, CPO is now trading at a price of 4,000 per metric ton. Okay, so you multiply it with 25 metric tons, so you get a contract value of 100,000. Sorry. Okay, then the minimum price fluctuation is 1 ringgit per metric ton, and the value per tick is 25 ringgit. So what it means is that for every 1 ringgit move in the FCPO is equivalent to a value of 25 ringgit. So for example, the market price is 4,000. When the price goes up 1 ringgit, if you're holding a buy position, you will earn 25 ringgit, and also vice versa lah. If the price goes down, then you will lose 25. Okay, the settlement is by physical delivery, and the final trading day for the contract is on the 15th of the delivery month, and the contract expires at noon. For trading hours, there are 2 sessions. Okay, the first session is from 10:30 a.m. to 12:30 p.m. and the second session is from 2:30 p.m. to 6 p.m. And then finally, the initial margin or the capital required to trade one FCPO contract is 7,000 ringgit. All right, so why do people trade futures? Okay, there are many reasons why futures is attractive. Okay, there are some examples. So it includes like leverage, high liquidity, bi-directional trading, and also low transaction costs. We'll look into each one of it. Okay, so first off is leverage, right? Futures is a leverage investment, which means that traders can trade on margin. Okay, leverage provides traders with the ability to utilize a small amount of capital to trade a greater contract value. So normally the initial margin or the capital needed, right, is around 5 to 20% of the full contract value. So it also means that a small movement in the market can actually translate into a big movement in your portfolio. So this is an example here, right? So let's say the market price for FCPO is now trading at 4,000, and one contract is 25 metric tons, so the contract value is 100,000. However, in the futures market, you don't need to fork out 100,000. You just need 7% of it, which is 7,000 ringgit initial margin to enter a position. So that is what it means by leverage. So we'll look into an example. Okay, so for example, you buy FCPO at 4,000, and then the market goes up 30 points, and you decide to sell off your position at 4,030 lah. So your profit is 30 points times 25 ringgit, which gives you 750 ringgit. So now we can actually compare the ROI. All right, if you buy FCPO right, in the spot market, which is also the physical market lah, okay, you need to fork out 100,000 for your investment. So your return on investment will be 750, which is your profit, divide by 100K, which is your investment amount. So you'll get a return of 0.75%. All right, but if you enter a position in the futures market, you only need 7,000 for the initial margin. So your profit, right, divide by 7,000, you'll get an ROI of 10.71, which is much higher than the spot market. Okay, let's take another example on a losing position. So likewise, you buy at 4,000, but the market is not in your favor and it dropped 20 points. So you decide to cut loss and sell off the position at 3,980, okay, for example. So your loss will be 500 ringgit. Now we compare the ROI again. In the spot market, 500 divide by investment amount, so your ROI will be negative 0.5%. Okay, but in the futures market, your ROI will be 7.14% negative. So in both cases, right, the ROI are magnified in the futures market as compared to the spot market. Okay, next is liquidity. So liquidity is important when choosing which contract month or which expiration date to enter the position. Okay, typically you want to choose the contract with the highest liquidity because there are a lot more volume, and a lot more volume will mean that it is an active contract because a lot of people are trading it. So the benefit of trading an active or high volume contract is that you can quickly enter and exit your position at the price you want. And a liquid market also means smaller bid-ask spread lah. So okay, this is an example for FCPO and FKLI in our Phillip Nova platform. So you can see under the contract here, right, there are many different months. Like there's October, November, December, January, etc. Right? So how do you find a contract that's most active and liquid? You can actually look at the volume column, okay, and then you find which one it has the highest liquidity, highest volume lah. So in this case, is 22107, which is the December contract. So this is the contract that most people trade. Same goes for FKLI. You just find like the volume, the highest volume, which is the October contract. Okay, in futures, you can also do bi-directional trading. So you can trade both the upside and the downside, regardless of the market direction. So for example, if you expect the market to go up, then you can long the market by buying into the position. So generally, you want to initiate a buy position when the market is in an uptrend. But if you expect the market to go down, and you can short the market by initiating a sell position. And you do this when the market is in the downtrend. So whether it's uptrend or downtrend, you can both capitalize on it lah. Okay, next is the low transaction cost. The transaction fees in futures market are relatively low as compared to the stock market or the cash market lah. Okay, we'll use KLCI in this example. KLCI is the Malaysia Stock Index. So the futures contract for KLCI is called the FKLI. So let's just say that we have the same contract value of 80,000 ringgit, okay, for both the futures and also stocks market here, just to make it even so that we can compare the transaction cost. So for futures, the commission is based on a fixed fee, okay, per lot per side. The only cost that you need to pay is the brokerage fee, which is 15 ringgit for FKLI in this example. So there is no stamp duty or clearing fees, and the total commission you pay to enter and exit a position is just 30 ringgit. So it means like 50 ringgit to enter and 15 ringgit to exit. Whereas for stocks, the commission is based on the percentage of the contract value. And there are brokerage fees, stamp duty, and clearing fees, which may vary according to the contracts. So in this comparison here, the fees in the futures market is much smaller than the stocks market lah. Okay, so who are the market players in the futures market? Okay, here we have three types of participants. First, we have the hedgers, the speculators, and also the arbitragers. So a hedger is any person or a firm that buys or sells the actual physical asset. So hedging using futures is a way to limit risk that arise from large fluctuation in prices of this asset. So it is like a form of insurance to prevent adverse price movement. So to put it simply, on one hand, the hedger holds the physical asset, and on the other hand, he holds a futures contract of the asset. The purpose of hedging is that the loss you make in one market can be covered by a profit in the other market. But also it is important to note that this is not 100% because there is no perfect hedge. But hedging is still a great option to help limit losses. So hedges can refer to commodity producers, wholesalers, retailers, or manufacturers, and also portfolio holders in the cash market. Okay, let's take an example of a corn producer or a farmer, okay, who uses a futures contract to hedge against the falling prices of corn. So let's say this corn farmer, right, is expecting that in 3 months' time, he can harvest his corn and sell it to the vendors. But he is concerned that the market price for corn might drop when his corn are ready for sale. So what he can do is that he can sell a futures contract now with the expiration date 3 months later. So if the time comes and the corn price indeed drop, right, he can make a profit in the futures market and cover some losses of his corn sales in the physical market. Yeah, so this is one example of hedging. Okay, next we have speculators. So speculation is the most common market activity that participants of the financial market take part in. And speculators are people who forecast a price movement and buy or sell the contract with the hope of making a profit when the price moves in their favor. So speculators do not own physical delivery. They just speculate the profit by buying contracts at a lower price and selling it at a higher price. So speculators bring liquidity and assume market risk, which makes them an important player in the futures market. All right, the third one is arbitrages. So arbitraging involves buying at a lower price in one market and also at the same time selling it at a higher price in the other market. So in other words, right, is to take advantage when two markets are mispriced. It can be between a futures market and also a physical market. Okay, this way, traders are able to benefit from the price difference in these two markets. But however, arbitraging is actually a very advanced technique lah. So yeah. Okay. We have just finished the first section on the basics of futures trading. So for total beginners, I hope it's not too hard for you to follow. And now let's look into the individual contracts for FKLI, FM70, and also FCPO. And then we'll look into what are the key fundamentals that drive these markets. Okay, this is a contract spec, okay, for FKLI. So the underlying asset is the FTSE Bursa Malaysia Kuala Lumpur Composite Index, or in short, it's called the KLCI lah. So the contract size is the KLCI index multiplied by 50. So to calculate the contract value, you take the current price of the index, for example, 1,600 in this case, and then you multiply it by 50 ringgit, you get 80,000. Okay, and the price minimum price fluctuation is 0.5 point, which is valued at 25 ringgit. So what it means is one point value will be 50 ringgit lah. So okay, for example, you buy FKLI at a market price of 1,600, and when the price goes up 1 point, you will earn 50 ringgit. But if the price drops half a point, then you will lose 25 ringgit. Okay, the settlement for FKLI is cash settlement. So because you cannot deliver a physical index, so you'll be settled by cash. And then the final trading day is the last business day of the contract month. The trading hours, as usual, we have 2 sessions. So the first session is at 45 a.m. to 12:45 p.m. and then the second session is 2:30 p.m. to 5:15 p.m. And the initial margin required is 4,200. Okay, the KLCI comprises of many different sectors. As you can see in this pie chart here, the biggest weightage are the banks, the F&B, and also the healthcare sectors. So in total, the KLCI represents the top 30 companies by market cap that are listed in Bursa Malaysia. And the good thing is that you don't have to worry about which stock to pick and trade, because just by trading one contract of FKLI, you are exposed to these 30 blue chips companies. Okay, next up is FM70. So FM70 is the FTSE Bursa Malaysia Mid 70 Index Futures contract that is traded on the Bursa Malaysia derivatives. So FM70 comprises of 17 mid-cap stocks, and you can gain exposure to all the stocks with one single futures contract. And this is the contract spec for FM70. So the underlying is the Bursa Malaysia Mid 70 Index. The contract size of one FM70 is the index point multiplied by 4 ringgit. Okay, and for example, like FM70 is trading at 15,000, and so you multiply it by 4 ringgit, you get a contract value of 60k. And the minimum price fluctuation is 5 index point, which is valued at 20 ringgit. And the settlement is also by cash. And then the final trading day is the last business day of the contract month, as well as for the trading hours, also 2 sessions, which is the same as the FKLI just now. And the initial margin required is much smaller, which is only 2,500. Okay, the components in FM70 are also comprised of many different industries. Okay, the largest weightage here are the consumer, the technology, and also the financial sectors. Okay, these are the top 10 companies within the 3 biggest sectors mentioned earlier. So some of which you might be very familiar with, such as Carlsberg, Hong Leong, and also Aeon. Yeah. Okay, let's now look into the factors that might potentially affect the FKLI and FM70 market. Okay, first is interest rates. This is a part of the central bank's monetary policy to adjust the interest rates, or the OPR, in order to control the economic growth and inflation. So if the central banks lower the interest rates, it will stimulate more borrowing for expansion of businesses, and more spending will lead to economic growth, which is good for the overall market. But if inflation is very high, then the central bank can raise interest rates to calm down the overheated economy. And we also have the oil price. So oil price movements can have an impact on the local market as well, because the oil and gas is a major sector on the Bursa Malaysia. So the demand of crude oil is also always there because oil plays a very important role in many economies. So Malaysia is a major oil exporting country within ASEAN. So the increase in oil price can benefit certain sectors like the oil and gas industry. Okay, next is the COVID-19 pandemic. So COVID-19 isn't just a public health crisis, but it also has heavily impacted the global economy. So it has significant economic impact across the globe due to reduced productivity, loss of lives, business closures, trade disruption, and negative influence on some industries. So due to the economic uncertainties and also the COVID-19 outbreak, the KLCI have been pushed below 1,300 points last year, which is a 10-year low. Okay, political uncertainty also affect the markets. So government decisions on policies and regulations that govern a country, right, have an effect on the companies, the local market, the imports, the exports, the purchasing power, and also the economy as a whole. So there will be some market movements following unexpected change, right, in a country's political stance, and also external challenges such as handling power between prime ministers. Okay, and then lastly, we have the trade war. So the US and China trade war has a long history, but it brings indirect impact on the performance of the stock market. So because US and China are the world's largest economies, so the trade policies will affect the world economy, especially because China is also a huge trading partner of Malaysia as well. Okay, so moving on to FCPO, right? This is the contract spec that we actually have gone through earlier, but maybe I'll just quickly go through again lah. So the contract size is 25 metric tons for FCPO, and then the minimum price fluctuation is 1 ringgit per metric ton. The settlement is by physical delivery, and final trading day is on the 15th of the delivery month, and the initial margin required is 7,000. So what are some factors that may affect the FCPO markets? Okay, the first one is weather season. So weather patterns they tend to affect the development and also production of CPO. And palm trees, they generally grow well in the tropical weather, which is usually warm and humid. So seasons of heavy rain or monsoon, okay, known as the La Nina, could lead to increased rainfall, which may flood the plantations and then hamper the harvest of CPO. So while during seasons of dry spell or extreme heat, okay, known as the El Nino, there tend to be less rainfall and could create a stress effect on the palm oil development, which will bring down the production yield as well. And okay, FCPO price is also affected by import and export volume. So the top 3 producers or the exporting countries are Indonesia, Malaysia, and Thailand, while the top 3 consumers or the importing countries are India, the European Union, and also China. So you can look at the import and export as supply and demand. So if there are more demand than supply, the price of CPO will increase. And for example, right, actually today the India government actually announced to cut the CPO import tax, right, from 20% to 7.5%, which means that it will become cheaper to buy CPO. So this will increase the demand and the price shoot up 160 ringgit just today. All right. Okay, the next one, we have competition from other edible oils. So the price of palm oil can be affected by other vegetable oil, such as sunflower oil, corn oil, and especially soybean oil. So if bad weather hits the soybean plantation, it can lead to an increase in the palm oil price, because once the soybean oil supply falls below the market demand, palm oil will become a substitution, hence increasing its demand. Okay, and then lastly, we have the festival season, which can also, festival season, right, can increase the demand for oil. So just for example, during Chinese New Year, okay, the Chinese will buy the oil, right, for massive cooking and baking. And Indians the same, right, for during Diwali, they also buy a lot of oil. Okay, so people use oil for festivals and also religious purposes. And with higher demand for this oil, then the price will also increase. All right. So yeah, we are done with the second session here on the introduction to some of the contracts and also the factors that will affect these markets. So now let's look at some of the technical parts on the order types and how to use them in your trading. Okay, there are 3 main types of orders, and we will look into each one. Okay, the first one is a market order. So market order is used, right, when you want to buy or sell a contract at the current market price. Okay, so when you want to buy, right, you want to buy a long position now, okay, at the market price, you refer to the ask price. And if you want to sell at the market price, you refer to the bid price. Okay, for example, right, you will see the bid price and ask price on your trading platform. So if you want to enter into a long position, you can click on the ask price here, and you buy at the market price of 3501. Excuse me. So if you want to enter into a short position, you click on the bid price and you sell at a market price of 3,500. So it's very direct using market order. Okay, the second one is limit order. It is an order to buy or sell a contract at a specific price that you want. So for limit order, for buy limit order, the price is placed lower than the market price. Okay, so while for the sell limit order, the price is placed higher than the market price. So let's look at an example. So this is how a contract is written in the platform. Okay, so BMD here is the exchange name, which is Bursa Malaysia Derivatives, and FCPO is the product code, and December 21 is actually the contract month. So let's say the market price is now at 3,500. So if you want to buy in at a lower price, let's say 3480, so then you will set a buy limit order at 3480. So if the price falls to this, the price, your long position will be executed. All right, however, right, if you want to enter at a short position and sell higher than the market price, okay, for example, 3510, so then you will set a sell limit order at 3510. So when the price goes up and hit 3510, your short position will be executed. All right, so the third one is stop order. So this is used as a stop loss to limit the loss on your existing positions. So a buy stop order is placed higher than the last done price or the last transacted price lah. Okay, so you use a buy stop when you want to set a stop loss on your existing position. And a sell stop order is placed below the last done price. So use this sell stop when you want to set a stop loss on your existing long position. Okay, let's look into an example as well. So let's say you are holding a short position. So of course you want the market to go down because you are shorting ma. But in the case, right, that the market goes against you and you want to protect your trade, you can actually set a stop loss. So now let's say that the last down price is 3,500. So you can set a stop loss for your short position, okay, by placing a buy stop order above 3,500. So for example, you place it at 3,550. So when the price goes up and reaches 3,550, your stop order will be executed and you'll be out of the trade. So this is to avoid additional losses if the market keeps going up. Okay, let's take another example. If you're holding a long position and you're afraid that the market will drop, okay, so you can set a sell stop order below the last done price. So for example, you set it at 3,450. Okay, so if the price falls to or below 3,450, your sell stop will be executed. Yeah, so this is the three main types of orders that you can use for your trading. Okay, now let's talk about margin call, because this is very important to know if you are trading. And basically, nobody likes to receive a margin call, because if you receive a margin call, what it means is that you don't have enough money in your account to hold your positions overnight. So, okay, for example, the initial margin for FCPO is 7,000, and the maintenance margin is that to hold your position overnight, you need 100% of the initial margin, which is also 7,000. So let me ask you a question. If your current equity is 6,000 and you hold a position overnight, will you get a margin call? The answer is yes, because it is below the margin requirement of 7,000. So long as your equity falls below the maintenance margin, you will get a margin call from your broker the following day. Okay, let's look at an example again. Okay, assuming that you have 7,000 to start off in your account, okay? So on day one, you long one contract of FCPO at 4,000, but the market dropped, okay? The market dropped 40 points to 3,960. So your unrealized loss is 1,000 ringgit because the market goes against you. but you decide to hold your positions overnight lah. So on day 2, your cash balance is left with only 6,000 because you lose 1,000 yesterday, am I right? So you'll receive a margin call of 1,000 because your cash balance is less than the maintenance margin. So the margin call amount is just the difference between your cash balance and also the maintenance margin. Okay, so what can you do, right, if you receive a margin call? So there are actually 3 ways to answer it lah. So the first one is to fund in or to deposit the margin call amount if you want to hold the position. And the second one is if you choose not to fund in, then you need to make sure your cash buying power remaining stays positive before the market close. And then the third one is to close your position. And if you do not do so, the broker house will have the right to force liquidate your position if number 1 and number 2 is not met, right? So yeah, that's about margin call. Okay, now we have learned about all the basics about futures trading. It also looked at examples of some contracts. So how can you begin trading? Okay, the first one is you need to open an account, right? A trading account. You can choose to open an account with us because it's free. Okay, second is to know your risk appetite because some markets can be a bit more volatile than others because it is more sensitive to certain market news lah. But it's also important. But it's also the volatility that actually give traders the opportunity to participate in the market movement. But just remember, right, to always set a stop loss and monitor your positions because risk management is very important. Okay, third one, can study the products that you are interested to trade in. So we have local products as well as foreign products, and we have different categories of products like the indices, agriculture, or energy futures. So you can pick one product, study it, understand it, and then you start trading it. So, okay, it is also important to understand the fundamental analysis and technical analysis. For fundamental analysis, you can read the news, follow the important key data or reports that will affect the markets. And for technical analysis, is to understand the charts and indicators such as RSI, moving averages. And different traders may adopt different techniques. So it's most importantly, it has to suit your own trading style. And then number 5, you can kickstart your trading journey. And also make sure you are always up to date with the market because any news or events could move the market. And trading is a long journey, so always keep learning and growing your knowledge. And lastly, happy trading. We wish you the best of luck in your trading journey. So that is all for my session. I hope you have learned something tonight. If you have any questions for us, please do type into the question box and I'll try to answer them later. So yeah, I'll give you some time to do so. Yeah, while you're typing any questions into the box, right, just to let you know lah, okay? Just for information, if anyone who is looking to open a futures account with us, Phillip Futures is actually the first broker in Malaysia to introduce this account opening online. So you can open an account with convenience, right, without having to come to our offices, and it's very easy. There are some particulars to fill up. So yeah, if you are interested, you can just visit our website or you can just scan the QR code and it will link you to the online application. Okay, the trading platform we use is Phillip Nova. It is a web-based platform and it's very easy to use. So you can just log in like how you log in your Facebook and then you can start trading already. So inside the platform, we have over 90 indicators and live charts, and also you can access to both the local and also foreign products. Yeah, so we also have a demo account for you to try out our platform. You can scan here to register a demo account, or you can also request from us anytime. And then we also have a mobile app version for our platform. So for those who are not always in front of the computer or you like to trade on the go, right, you can download our Phillip Nova app and trade anyway. And you still get the same features and live charts inside as well. All right, just to let you know, we are currently running a few promotions. Okay, the first one is Jump Trade with Phillip. So if you open an account and start trading with us, you can receive cash reward of 100 ringgit and also Food Panda vouchers. If you would like to learn more, you can scan the QR code here, or you can always drop us any message. And the next one is Phillip Star Trader. So for this promotion, you can win lucky draw prizes worth up to 50,000 ringgit and also receive up to 4,000 cash rewards when you trade with us. So to learn more, you can scan the QR code or you can always approach us. Yeah, so you can connect with us on these platforms. Okay, you can find us on Facebook, LinkedIn, and also YouTube by searching Phillip Futures Sdn Bhd. We are also on Telegram, so you can search Phillip Futures and join our Telegram. We post a lot of our market updates there, and we also regularly post updated news and events, promotions on our social media like Facebook. So be sure to check them out. Right, and also if you haven't liked or subscribed, we'll appreciate if you do. And this webinar is also recorded, as well as our previous recorded videos are all uploaded on our YouTube channel, so you can watch our previous videos there. Okay, this is our Kuching branch contact number for you to reach out. So you can take a screenshot if you want, and if you have any questions, you can always contact us here. Okay, so back to the Q&A. All right, let's see if there are any questions. Hold on, let me check any questions here. Okay, there is this question, okay, from Benji Chu. Okay, what happened if I still hold a commodity future after the contract, and will I receive the physical goods? Actually, usually this will not happen because for retailers, we just want to speculate the market, right? And our dealers will actually inform you when it's nearing the expiry. So you can always close your trades or roll your trades. So you don't have to worry. So you won't get any physical goods, right? If you forget to close, right? Yeah. Is Phillip Nova free? Yeah. Our trading platform is actually free. There's no charges. You can try out our demo account, or you can contact us for any info that you want to know. Yeah. Okay, what are the criteria for account opening? There are just some documents you need to submit. All right, so for opening an account online, okay, you just need to fill in some particulars, and then you need to upload your IC with signature. And you need to give us your latest bank statement and also a minimum funding of 1,000 ringgit to activate your account. But this 1,000 ringgit, you can use it to trade later on. Okay. So there's one more question here. Okay. Are futures all Sharia compliant? Okay, there are different types of. I mean, we have different types of products, but for Bursa local products here, they are all Sharia compliant, so you don't have to worry. Okay. So I guess that is okay. There's another question here. Okay, must I be a sophisticated investor to open an account? No, for futures, actually, you I mean, for retail, you can just open an account if you meet I mean the requirements, as in the documents needed lah. So you don't have to be a sophisticated investor. Anyone can open an account. Yeah. Of course, you have to be above like 18 years old and above, then it should be no problem. Yeah, because we also do a KYC on that. And if you have any questions you'd like to know more, you can always contact us lah, and also drop us the message. Where can I get a demo account? Okay, I have the link here. Hold on, let me go back to my slides. Yeah. Yeah, so you can scan, right, the QR code here to get a demo account. Okay, I guess it's pretty much that. Yeah, if you have any more questions, or if I do miss any questions, right? You can always drop us a comment here in the box, and then we'll get our representative to contact you. All right. Okay, last question here. If I already have a CDS account with other broker, can I open with Phillip again? Yes, you can open an account with a new broker. So, like say if you have a account with other broker, you can still open with Phillip Futures. Okay, but with Phillip Futures, you can only open one account, right? Yeah. So you can only open one account with one broker in that sense lah. Okay, I guess that's pretty much it. So we have come to the end of our webinar tonight. If you have any questions you still want to ask us after this, just feel free to contact us, and we'll be happy to help. So thank you very much for joining us. We will see you again next time. All right. So take care and good night.